Volatility, and what is it and how do you trade volatility when you hear it's upon us? Chris Beauchamp is with us now to take a look at this in some more detail. You've written recently about volatility on the website for IG. Explain in words of one syllable what it is exactly.
Well, in its classical sense, volatility means a wide daily range in markets, market going up and going down a lot. Now, when most people talk about volatility, they mean markets going down. You don't hear about concerns of volatility when the market tends to march higher day after day, but volatility does just mean it swings widely in both directions. And markets go through periods of quiet volatility and times of very great volatility when they move around a lot intraday. We've come back to that sort of period after a time in August and indeed in July when there wasn't very much volatility. Now the shorthand for talking about that is the VIX index, which is a measure, an index of options placed in the S&P 500. It helps to measure the daily activity being traded within the index. So you get this sense of how busy it is. Of course, the VIX itself, it's talked about as this great predictor, if you like. It tells us what's going to happen next. Actually, it tends to be just the inverse of what the S&P 500 is doing, but it is a useful gauge. So during July and August, the VIX itself was down at around 20 or below, which tends to signal low volatility. In fact, it was the lowest in about 26 years, and then it's moved higher again back to 30 as we've come into September.
So if someone trading on the IG platform likes increased volatility?
Volatility tends to be a good thing for day traders, really, or as people looking at the shorter term time frame, they give you more opportunities, certainly intraday, to take advantage of moves perhaps against the trend, and then the trend reasserts itself. I think if you're looking at trading times of higher volatility, the classic rules apply. If you're looking at placing a trade, then if you think it's going to move around a lot intraday, then you want to cut back on your position size, because you could be right in the direction of the trade, but if you're too much of a position size, it's too big, then you can see your profit and loss swing around wildly, and you might feel the urge to close out that trade too early. And the other classic way of dealing with it is to widen out your stops. So not only are you risking less on each trade, but you're giving it more room to breathe, because it does move around a lot more.
You talk about the markets, when the markets go down, you're talking there about equity indices. You referred to the S&P when talking about the VIX index. What about other markets? Because when you have a currency pair, for example, when one goes down, the other one goes up, in times of heightened volatility, when you get equity markets on the way down, what tends to be the safe or the predicted trade on the FX markets?
Well, and you tend to see equities sell off. You tend to get a move back to the US dollar, to these safe havens, if you like, because people see those as being much less volatile. So things like the dollar index, or they go into treasuries, into bonds. With FX markets, things like, for example, cable, the pound against the dollar, it tends to go down more or less in lockstep with equity markets, and the same thing tends to apply with commodities as well. So the VIX is used as a shorthand for volatility across all markets. Of course, it's related closely to the S&P 500, but usually when that moves a lot intraday, you tend to get other assets following suit.
One final question. What causes volatility? Is it special events? We've got the US election, of course, coming up in November. Fed interest rate decisions, Bank of Japan, what it might be. Is there anything that causes volatility to stir?
Frequently events do boost volatility. So as you noted, we do have the Federal Reserve interest rate decisions. Brexit was a classic one, of course. You do see big moves around big events. We had one with the Bank of Japan's decision. People think the market will move one way and then it moves another. So it's these times of big movements that people can take opportunities. But remember, they can catch you up very, very quickly if the market does move against you. Okay,
all right, Chris, thanks so much indeed. Chris Beauchamp there with analysis of just what volatility means and a little bit on how to trade it.